Is the apartment market getting ready to crash, whether this year in 24 or next year in 2025? Or have we already passed the bottom of the market, that trough in this cycle? And are we getting ready to experience many years of excellent growth, and are the fundamentals set up in a very positive way for multifamily? You have seen the articles talking about major declines in commercial real estate. We're going to take office kind of out of the conversation a little bit because office has its own fundamental problems. We're really just talking about multifamily here today. Now, there's a lot of reasons to be, concerned about the multifamily market. Great Capital, we put out a really two detailed research reports early last year, talking about the issues and the concerns with a wall of potential loan maturities in the multifamily space, specifically short-term bridge loans that when they were originated, we're only charging, 4% interest rate. But as interest rates increased, since they're floating rate loans, those debt service payments have ballooned, doubled, and even tripled in some cases, wiping cash flow out completely and putting a lot of apartment operators in really tough spots. Values have also declined 15 to 30% depending on the market. So even if you had some increases to your net operating income, the valuation metrics, those cap rates, since they've increased, prices have come down, cap rates have increased, that makes it very difficult to either refinance that loan on that short-term bridge loan or to sell it to a buyer and make any money. The reality is we've seen many large apartment operators have to face foreclosures already. There's definitely blood in the water right now, and the operators and buyers, they're starting to get that sense, but there's still a ton of concern, rightful concern from equity investors and lenders of, is now the right time to jump into the market? Well, Blackstone put out a really interesting piece, really touching on this. Pattern recognition, investing before the all clear. And what it did is it examined back in the great financial crisis, mainstream media publications coming out essentially calling for further declines in commercial real estate, when the reality is all of those articles came out after of the bottom of the market. As we see, the pre-GFC peak was in June 2007, and that's where the property value index, so we're going to be looking at the same index here in just a little bit, kind of peaked again back in June 2007. The trough, according to this index, was in June 2009, but most of the articles calling for continued crashes took place after the bottom had actually occurred. Reuters came out after 2009 with a piece entitled "Equity in U.S. Commercial Property May Evaporate." The Wall Street Journal, shortly after that, "Commercial property owners choose to default." And then Forbes, shortly after that, "The greatest real estate bubble in modern history may not be done bursting." Well, if you were following the anecdotes that those media sources were putting out there, you would be led to believe that the worst was still in front of us, to stay in cash and to not deploy into commercial real estate, especially not multifamily. The reality, the truth, though, is that would be the best time to invest in real estate over the last 2 decades. So the question has to be, are we in a similar scenario in which much of the market, maybe half of the market, is concerned, a little bit nervous to take action, not to see pain, they don't want to lose any money, no one does as an investor? Or is now the time, as I think half or maybe less than half of investors are starting to believe, that today, now, is the moment to get into multifamily, into commercial real estate, to take advantage of very low prices? The 3 points that Blackstone is trying to make is, if you look at the real estate cycle coming out of the GFC, values bottomed well before market sentiment suggests, and then while headlines remained negative for years, values were actually improving. The Blackstone, not just putting this piece out, obviously they're putting their money where their mouth is. They have an incredible amount of dry powder that they could deploy, and they started getting really serious about getting back into the multifamily market in 2024 with their $10 billion all-cash acquisition of Air REIT, which is a publicly traded multifamily REIT that was traded on the stock market. They're taking that private and deploying their capital into multifamily. It's not just Blackstone, obviously, is the largest owner of apartments in the United States, one of the second largest. KKR, similar, is making a very large bet into apartments by paying $2.1 billion for over 5,200 apartment units across the country. The saying goes, follow the smart money. Now, you never want to follow anyone blind, but certainly there is billions of dollars being deployed, which in my opinion is truly setting a price floor on the market, which is hovering around kind of a 5 cap, plus or minus. That gives a lot of confidence to other institutional investors that there is the all clear, and certainly the bright minds of Blackstone and KKR are making conclusions that we are past the market trough. Again, coming back to this piece, the articles may be scary, but those scary articles may be the signal that it's time to take some action. All right, getting to a little bit, still anecdotes, but a little bit of data. This is a sentiment survey that the National Multifamily Housing Council does. I think they do it at least every quarter, if not every month. I believe, every month. They survey financing conditions, how tight or loose the market is for an equity, for sales, also debt. We all know that 2021 market was so tight. In July of 2021, out of 100, we were ranking on their market tightness index, according to the NMHC, a 96, an incredibly tight market environment. This was a period where properties were being bid up millions of dollars over their asking price, and dozens of buyers were trying to buy the same property. Cap rates were being traded well below 4, even into the 3% range. It was absolutely insane, and folks were buying prices that were simply too high and the cash flows did not support. The only way that those acquisitions worked was some very cheap floating rate financing that had not only dried up, but those rates increased dramatically. You can see after that moment in July of 21, things started getting a little bit looser, and we really kind of, according to this, from a tightness standpoint, really bottomed out in January of 2023, just before the start of this year. Now, things have kind of ebbed and flowed throughout 2024, but as we see, really starting in April and then continuing into July, we have made up a lot of the tightness, and it's becoming a slightly tighter market, which means more buyers are coming into the market and competing on properties. Also, from the equity finance index, showing how much equity is available for apartment acquisitions. Again, it was very difficult back in October of 22 and throughout 2023. In July of 22, got all the way down to an 18. But now things are tightening up again. Equity is becoming more available. The last 2 quarters that was surveyed back in July, we're at a 49 as well as a 49 back in April. Debt also has come back. We were all the way down in July of 22 at a 3 according to this index. Now we're back at a 63. Much more favorable buying conditions, which allows for more sales to transact and again that floor to take place. And I think with the major investments from Blackstone and KKR, that gives other institutions confidence that all right, now is the time to start considering making acquisitions in the multifamily space, which again brings in that floor of further price declines. And in fact, we're actually seeing some cap rate compression and price increases. According to Green Street, their commercial property prices are trending upward. Looking at this data, this is looking at property pricing, the huge surge in property pricing from 2020 through kind of the early half of 2022, a huge surge. And then after that, the declines that taking place kind of halfway through, 2022, especially in 2023, and then in 2024, we're trying to figure out where we are. As you see at the kind of the last piece of this graph, we're starting to move up just slightly. And if you look at values over time, from the recent peak, so when we peaked in the market, all commercial property prices are down about 20%. But over the last 12 months, prices are only down about 5%. And in the last month, however, prices are actually up 0.7%. So for certain, we know that the declines have slowed down. The rate of growth or decline has slowed, and in fact, prices are actually starting to recover, which you would expect seasonally, but if we were going through a true crash, you would continue to see those declines. Getting back to apartments really allowed the entire commercial real estate index to be positive this last month. In the last month, apartments actually saw a 4.9% increase in value, where most other property sectors were essentially flat. Over the last 12 months, apartments were only down 2%, whereas most other property asset classes were down further. Industrial is down 10%. The rest of all properties were down by 5%, office down 9%, healthcare down 9%, net leases down 3%, data centers down 5%. Now, from the recent peak, again, apartments down around 22% relative to the entire property sector down 23%, but you can see that the realization that the fundamentals in apartments are very solid over the next 10 years. We're just going to see supply start to slow down into 2025. And with increased rental inflation, we're at peak household formation right now in the United States. Homes are incredibly difficult to afford. No one can afford a mortgage payment, let alone a down payment. There's more demand than we've ever seen in the apartment industry. I think we're at like a 20-year peak in absorption rates right now. We're seeing a ton of supply that's counteracting that. Surprisingly, we're actually able to kind of keep our head above water. Now, looking at one more piece of data, this is research from CBRE. We're looking at cap rates specifically. The last index was looking at property prices. Now we're just looking at cap rates. So when cap rates go up, prices go down. When cap rates go down, prices go up. It's inverted. It takes a little bit getting used to, but it makes sense when you do the math. So we saw cap rate expansion, that's prices going down on this chart, all the way from Q2 of 22 all the way through Q4 of 2023. But starting in Q1 of 2024, this year, we actually started seeing cap rates compress once again. We saw further cap rate compression in Q2 of 2024. Again, the spreads between going in cap rates and exit cap rates, they're still very tight, but we would expect those to start widening out again as we get into a more normal market period. So the bottom line is some of the biggest players in the apartment and in commercial real estate are all starting to get back into the market, whereas we see I would say more layman individuals, folks that are in the media writing articles that are a little bit sensational, but I think that could be the indicator, the trigger to tell us that now is the time to actually get into multifamily. The reality is, as we saw, prices are down, according to Green Street, 20%. In some cases, they're down even more, closer to 30%. Some cases, maybe a little bit less. Capital markets and interest rates are going to be normalizing. What that normal looks like, I can't tell you, but interest rates will most likely be lower than they are today. We're absorbing record levels of apartments right now. Once we get through this supply wave, we really have, I think that's when the all clear is. That's when I think cap rates will severely compress, again, end of 25, early 2026. But the challenge is if you wait until the end of 2025 and early 2026 to start making your acquisitions, you're going to be buying at higher prices because groups like KKR, Blackstone, and Gray Capital, we're making acquisitions now at elevated cap rates at low prices to take advantage of the growth over the next several years. Still need to watch out for black swans and other, shoes to drop. We still have a lot of loan maturities that are floating out there. Many of them are being worked out by lenders and banks. Other black swans that are floating out there, well, it wouldn't be a true black swan if we knew exactly what it was. But obviously, the banking sector still has to work through all of this debt going from low interest rates to high interest rates. We have multiple wars going on across the world right now. So there's all kinds of things that we can always point to be concerning. Almost all of that are beyond our control. And so is it better to buy the rumor and sell the news or to wait for the all clear? Take that to heart and remember what Warren Buffett said, be greedy when others are fearful and fearful when others are greedy. All right, my name is Spencer Gray, President and CEO of Gray Capital. Hope you appreciated and enjoyed this video. You got something out of it. Make some really smart investing decisions. None of this is investment advice. Make sure you sign up for the Gray Report newsletter. You can find it at graycapitalllc.com/newsletter. And make sure that you're subscribed to the Gray Capital YouTube channel to stay in the loop for all of our latest market research updates, videos, educational content, and more from the Gray Capital team. And hey, why not give this video a like and leave a comment below? All right, see you on the next video. Thanks.